Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hemoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're delving into the recent turmoil sparked by the minutes from the United States Federal Reserve meeting. These minutes have sent ripples through the financial markets, with significant implications for Canadian mortgage rates. On December 18, 2024, the Federal Reserve released minutes indicating that they expect to reduce interest rates by only 50 basis points in 2025, contrary to the market's expectation of a 100 basis point reduction. This unexpected news has led to a sharp repricing of financial instruments across the board, including future earnings, forward cash flow projections, exchange rates, currencies, and bond yields. The Federal Reserve's decision is influenced by their dual mandate to maintain steady prices and employment levels. While employment appears stable, there is heightened concern about inflation potentially making a comeback. This concern has caused the Federal Reserve to adjust their rate-cutting plans to prevent reigniting inflationary pressures. In contrast, the Bank of Canada faces different challenges. With a declining economy and increasing unemployment levels, there is pressure on the Bank of Canada to lower rates more aggressively. However, the recent developments in the United States are likely to influence Canadian bond yields and consequently mortgage rates. Following the Fed's announcement, the Canadian dollar took a hit, dropping almost a full percent in a matter of hours. This depreciation further widens the gap between Canadian and U.S. overnight rates, signaling more volatility ahead for the Canadian currency market. Stock markets also reacted strongly, with the Dow Jones Industrial Average dropping over 1,100 points and the S&P 500 falling nearly 3%. Higher future interest rate expectations have led to a pullback in stocks as they adjust to the new economic landscape. Interest rates on bonds have seen a notable rise as well. The U.S. 10-year Treasury yield increased by 12 basis points, approaching a critical resistance level of 4.50%. This has a direct impact on Canadian 5-year bond yields, which rose over 9 basis points, surpassing the psychological 3.00% mark. As a result, Canadian lenders are expected to increase fixed mortgage rates in the coming days. Home buyers and those looking to refinance should act quickly to secure pre-approvals and rate drop requests before rates climb further. In summary, the Federal Reserve's latest minutes have set off a chain reaction in the markets, with higher than anticipated interest rates impacting everything from currency values to stock prices and bond yields. This environment presents challenges for Canadian mortgage brokers and homeowners, necessitating careful navigation in the months ahead. Canadian home buying activity has been on the rise, with recent months showing significant increases in sales. According to the Canadian Real Estate Association, there was a 26% jump in home sales last month compared to the same period in 2023, following a 30% increase in October. These surges are largely attributed to the Bank of Canada's series of interest rate cuts since June, which have helped bring buyers back into the market. The Bank of Canada's latest move, a 50 basis point reduction in its benchmark rate, marks the second consecutive oversized cut. This has further boosted borrowing power and expanded budgets for potential home buyers. Sean Cathcart, the Canadian Real Estate Association's senior economist, suggests that this trend could lead to a more active winter market than usual, especially with new mortgage qualification rules coming into effect. Blue Shore financial advisor Nico Wong highlighted that the central bank's rate cut is positive news for home buyers across Canada, enhancing their ability to borrow and increasing their purchasing power. Wong noted that the lower borrowing costs will not only benefit mortgages, but also other financing needs such as car loans and student loans, potentially allowing individuals to allocate extra funds towards home purchases. Alongside the rate cuts, new mortgage rules have been introduced, effective this past Sunday. These rules raise the insured mortgage cap to $1.5 million and allow 30-year amortizations for first-time homebuyers. While experts believe these changes improve affordability, they also warn of potential short-term price inflation as a result. The aggressive rate hikes by the Bank of Canada in 2022 and 2023 aimed to curb inflation, which peaked at 8.1% in June 2022. With inflation now within the central bank's target range, the focus has shifted to reducing rates further to support economic growth. Nico Wong anticipates additional rate cuts next year, although not as large as the recent ones, which should continue to ease borrowing costs. Despite the favorable conditions for homebuyers, the Royal Bank of Canada projects that the housing market will grow at a measured pace in the short term. Assistant Chief Economist Robert Hogue points out that affordability issues will still limit some borrowers, even with new mortgage rules in place. Certain regions, such as the prairies and parts of Quebec and Atlantic Canada, are experiencing more activity compared to British Columbia and Ontario, where recovery is still ongoing. Nico Wong also mentioned that while the recent rate cut enhances purchasing power, the real estate market is typically slower during the holiday season. He expects the market to pick up again in the spring, aligning with the usual seasonal trends. Overall, the outlook for Canada's housing market remains positive, with the potential for more growth as rates continue to adjust. In November, the housing construction sector in Vernon experienced a notable uptick. The Canadian Mortgage and Housing Corporation reported 98 housing project starts in Greater Vernon, marking a significant rise from the 24 starts recorded in November 2023. This increase included 9 single-family homes, 4 row houses, and a substantial 85 apartments. Despite this month-over-month improvement, the year-to-date figures for housing starts in Greater Vernon reveal a more tempered picture. By the end of November 2024, there had been 258 housing project starts, a drop from the 334 starts recorded during the same period in 2023. This suggests that while November was strong, the overall trend for the year has been somewhat subdued. Meanwhile, data from Kelowna showed 52 housing starts in November, contributing to a year-to-date total of 3,771 starts in 2024. Both figures represent an annual increase, indicating a more robust growth pattern in Kelowna compared to Vernon. Looking at a broader scale, both the province of British Columbia and the entire country saw housing construction accelerate in November. British Columbia recorded 4,048 housing starts, up from 3,108 in November 2023. However, the year-to-date total of 39,651 starts in 2024 is still down from the 42,941 recorded in the same period last year. Nationally, Canada reported 22,345 housing starts in November, a significant increase from the 17,198 starts in November 2023. The total number of housing starts across Canada from January to November 2024 reached 210,457, surpassing the 204,604 starts in the same 11 months of the previous year. Today, we're diving into the real estate market to uncover where you can find the most affordable homes in the Greater Toronto Area and Southern Ontario. Inflation has made finding an affordable home in Southern Ontario quite a challenge. However, with recent interest rate declines, more people might be able to take that important step toward home ownership. According to a new report from real estate brokerage Zoocasa, there are still pockets of affordability to be found, whether you're looking for a detached home, a semi-detached townhouse, or a condo apartment. Detached homes across the Greater Toronto Area, on average, come with a hefty price tag of $1,369,132. In Brampton, the average price for a detached home was recorded at $1,016,260 in November, whereas Mississauga saw an average of $1,425,730. For those seeking more budget-friendly options, moving farther out might be necessary. Zoocasa's report highlights Essa, a township near Barrie, and about 100 kilometers north of Toronto, as the cheapest area near the Greater Toronto Area. Essa offers a small-town charm while still being accessible to the city, making it ideal for day trips or weekend getaways. The average price of a home in Essa is $709,583, which is nearly half the cost of the Greater Toronto Area average, at 48.2% less. Other areas offering more affordable detached homes include Durham Region's Brock Township at $715,389, Oshawa at $859,463, and Georgina, southeast of Barrie, at $829,767. These areas provide viable alternatives for those willing to commute. If you're considering semi-detached homes, Durham Region might be the place to look. In Pickering, the average price for a semi-detached home is $660,778, offering a solid 30.9% savings compared to the Greater Toronto Area average of $956,789. Oshawa shares the same average price of $660,778, while Essa follows closely at $675,000. New Tecumseth, just north of Vaughan, is priced at $764,251. For those interested in townhouses, Essa continues to be a value leader with an average price of $631,950, allowing buyers to save 29% compared to the Greater Toronto Area's townhouse average of $889,199. Other affordable options include Orangeville at $717,000, New Tecumseth at $727,500, and Oshawa at $802,000. Condo buyers can also find budget-friendly options, even within Toronto. Orangeville offers the most economical condo prices at an average of $388,000, representing a significant 39.1% savings compared to the Greater Toronto Area, average of $637,390. Other affordable condo markets include Oshawa at $424,181, Clarington at $512,600, and New Tecumseth at $567,000. In Toronto, while the average price of a condo apartment is $713,364, there are still neighborhoods offering more affordable choices. West Hill and Centennial Scarborough stand out with an average price of $426,167, a full 40% lower than the citywide average. Similarly, neighborhoods like Dorset Park, Kennedy Park, Black Creek, and York University Heights offer notable savings with prices at $506,200 and $508,478, respectively, which are 29% below the Toronto average. So, whether you're looking for a detached home, semi-detached, townhouse, or condo, there are still opportunities to find a more affordable option within the Greater Toronto Area and Southern Ontario. The key is to explore these pockets of value and consider your commuting preferences. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time, and stay informed with the latest industry insights.